Have you ever wondered what causes growth? I'm not talking about steroids and stuff like that, but what causes sustained economic growth? And as it relates to you as an investor, what are some of the things that actually create return? Well, one of the factors is an injection of credit into the system that you're interacting with. The more money there is in a system, the more growth that just seems to occur. And at the risk of being oversimplistic here, it is really important that there is a constant pumping of credit into a system for there to be sustained economic activity. So today, we're actually going to be talking to someone who has experience with banks and non-banks. And we're going to be talking about how either an abundance of credit or a lack of credit can increase or decrease economic activity. So I'm catching up with Simon Paris from Merchant Banking Group. I hope you enjoy. Promises to be a good show. So for the majority of Kiwis out there
Yes.
who fit inside the box,
Yes.
they'll have access potentially to a cheaper funding line, whether it's to get a line of credit to fund their business, purchase a farm, purchase a home or investment properties, but they have to fit inside a certain sized box.
That's right.
And that's a highly regulated box by the Reserve Bank.
Mm.
But then there's another little box to the side, a much smaller box, isn't it?
Yes.
Growing, but
Yes.
smaller box.
That's right.
And that's where the non-bank sector sits.
That's right. And it's interesting, looking at the non-bank sector, it's been really growing in the last few years. In fact, profits went up about 23% on the last year.
Wow.
And it's becoming a billion-dollar industry.
Okay.
But ironically, it still accounts for less than 1% of mortgage lending in New Zealand.
Less than 1%.
Less than 1%.
Which is really fascinating. Isn't
It
it?
is.
There's definitely been a shrinking of the size of that box, and they have left a lot of good, safe, prime opportunities on the table.
Yes.
Would you agree?
Oh, I totally agree. And it's there's a couple of things playing here. And, off the back of the Royal Commission, that started to change the course of what banks are willing to do or how they operate. And I just saw recently the Reserve Bank is looking to double the capital requirement that banks need to hold. It's safeguarding the market, which is good.
Yeah.
I mean, I think that's really prudent. But what that means is that the bank has to hold that capital, so they start to cherry pick the best transactions that come through.
I'm just trying to think of an analogy of, because you have kids, right?
I do.
And you want them to be safe, you want them to have fun, you want them to play sport, but at the same time, you don't want them to get a head injury. That's like my biggest concern. Is
Yes.
breaking something, and they're in a cast for a while. It's like the parent's nightmare, and so you take less risk. That's what we're always saying. Don't jump off the bed. But when you're constantly telling people to take less risk, they don't want to play anymore.
Yes.
They shrink back. They'll sit in front of the device because you're taking away all the options. And I'm not saying that to be critical and to use that analogy to be critical on what the Reserve Bank necessarily is doing, but with the regulator kind of playing in that space more, I get it. It's like, why would we want to lend to this person when we're going to get nailed for it? Let's just lower our rates and just kind of chase this prime business and
That's
trade
right.
it with each other. That's effectively what they're doing at the moment, isn't it?
It is. And they follow very strict criteria, and those criteria have been put in place to minimise the risk of loans going into default.
Which is a good thing. That's
It's
great.
a very good thing.
Yeah.
And it's a prudent way of acting. But what I feel is that the human part has been sort of taken out of their analysis. So it becomes putting in the figures into the system. Computer says yes, computer says no.
That's right.
And that human mitigation or broader picture doesn't come into the mix anymore. And I think that part of analysis is becoming sorely missed.
And there was a really awesome bit of marketing that I remember seeing. It probably disappeared maybe 4 or 5 years ago. One of the main trading banks in New Zealand had a slogan that said something like, and don't quote me on this, we live in your world.
Yes.
And I love it because it's so not true. it's so not true. And I don't mean to be disparaging on this bank, but I guess that things have changed so much so that, like you say, computer says no. And unfortunately, the owner of that computer is the one who owns the money. And they've been told that they have to do it a certain way. So they're on the other end. And yep, they get your world, but if you want their money, you do have to play by their rules at the moment.
Yes.
Doesn't matter how much sense it makes. And it usually does make a lot of sense what you're trying to do.
And it comes back to that picking the cream off the top.
Yeah.
If you had someone that came to you with 5 years of financial performance that has been steady and has been successful, you're going to give that funding over to someone that might be in a startup phase, that their first year as they were growing the business, the revenue was not as high as perhaps the second year. But what banks will typically do is they'll take the lowest. So you all of a sudden sort of become disadvantaged for growing. Or you become disadvantaged for maybe having a bad year that could be completely explained. You may have lost a massive client, but you've built that back. Again, those sort of mitigating factors don't become part of the analysis anymore. And to be fair, they used to.
That's right.
They used to.
Oh, yeah, totally. Tell me some of the solutions to problems that you would administer on a daily basis.
Sure. Working capital, as well as purchase of assets, they are two key parts that can be facilitated in a non-bank. And in the industry that I'm in, we are asset backed, so that requires a property or a security to be in place to back that up, rather than the unsecured that we were talking about prior.
Yeah.
And the kind of metrics that we look at when we do this type of lending comes down to the history of the business, the business plan, the forecasts, as well as the experience of the person that's at the helm of this business. And then we take a look at the rest of their life. So what is the security, their house that's being offered? Where is it located? What is the quality of it, etc. And then a thing that the non-bank is very focused on is the exit. When I mean exit, I mean typically the funding is not with us for a long time.
Yeah, we're not talking about a long-term
We're
solution.
not talking long-term solution. We're talking about giving people a solution to grow or start their business, where in the next 12 to 24 months they will be in a position where the bank will actually want them. And I've seen it many times where someone comes to us and says, look, we want to buy this business, or we've got this idea, here's our business plan and our forecast, and we look at the broader picture and say, yeah, look, it's a good idea, we like it, we like the whole deal, and we provide that funding. And more often than not, within 6 to 12 months of trading, once they've got that history, the bank starts knocking on the door saying, hey, we'd like to...
They're bankable again.
We'd like to support you now.
And do you find that it's kind of like almost we're just staying with you for a while?
Yes.
And we're so that we can get the funding that we need to grow. And then when they go back to the mainstream bank for cheaper, more plain vanilla funding,
Correct.
would the bank look at that and go, well, hang on, you've just been hanging out with these dirty critters over here. We don't want to touch you. Or are they kind of like, well, thanks for not bothering with us, but now we're really happy to deal with you because everything's a lot straighter.
That's right.
Yeah.
It becomes, going back to that computer says yes analogy, they couldn't handle the complexities of what was going on in its startup phase, but now that it's more mature in its life cycle, it becomes a far easier transaction to look at. And I don't think that they look at the prior funder and go, ooh,
That's right.
wonder what's going on there.
Yeah.
It's more about that fund has given that person an opportunity, and that has worked out, and now we would like to fund them and support them in their future as the business grows. And that is sort of the way that we see it as well. We help out at the startup phase, at the infancy, and guide them through that and let them on their way. And I find that very satisfying, that side of the job.
Yeah, well, you've just set somebody free. You've just given them the tool that they've been yearning for to actually really grow their business, whether it's a manufacturing business and importing furniture business. So let's talk a little bit about some of the myths then, because we're kind of skirting around the edge of one big myth, which is, well, if I have a really good working relationship with my bank over time, just like my parents taught me, if I have one bank manager over time, they'll look after me. And even though it doesn't quite fit with inside the criteria, they'll help me out because they know mom and dad. They've got lots of money with the bank. Talk to that.
Yes, that is a myth that I had lived with for many years in my banking career. And the time spent at a bank does have some weight, but it doesn't change the decision tool or the outcome that the decision tool makes. And a good banker will say, it's a no right now, but here is an alternative solution. And that was something I was very passionate about, is that I began to say no a lot more than I was saying yes. But to mitigate that, it's, well, here's what you can do. Here's some strategies. Here's some alternative funders that might be able to assist you to get you started. And once you hit this metric or this goal, then come and talk to me again, and I would like to continue that relationship with you.
Cool. Okay. So, I guess that probably for you specifically, that would have been one of the gateways for you to consider working in the non-bank yourself, because to a certain extent you were saying no, but here are some of the strategies, some of the people that you could talk to make it a yes, and then come and see me later on. And you're probably tired of doing that more and more, right?
You're spot on.
Yeah.
Spot on. And I had a strong belief in these clients that were coming to me, and I saw their vision, I saw their future, and a banker's hardest job is saying no. Because that's someone's livelihood, that's someone's idea, and you sort of feel like you're cutting them off at the knees sometimes. But my frustration is that I saw that there was an opportunity there, and when I found out about non-banking, and this is sort of part of the mystery of non-bankers, I was in banking for 17 years, and I knew of non-bank, but I didn't really know what the mechanics were or how they sort of operated. Sort of opened my eyes to how you can help people by looking at the broader picture and giving people an opportunity to live their dream while still making a rational and well thought out decision.
Like you've seen enough transactions enough, and you just have this gift of being able to smell the BS when you see it, but also equally so, if there's genuinely good opportunity, you'll be able to discern what that is, won't you?
Absolutely right.
So tell me, I'm just thinking, right, well, I've been turned down by the bank because I need to borrow an extra $300,000. I'm happy to put it against the value of my home. Bank said no to me. I really need this $300,000 because I need to buy a huge amount of stock for this big project that we have coming up, or something kind of like that. I guess, and I'm guessing a lot of the initial objection will be because of the cost. The bank, I see these advertised rates that are less than 4%. Why would I pay twice as much to go or more and pay fees to go see a non-bank lender to get this done? Well, I'm just not even going to do it now. Do you see that a lot?
All the time. And in fact, the biggest objection that I come up against is price. Why is the non-bank sector so much more expensive than the main bank? And it comes down to two factors really. One is the cost of funds, and the second is the risk profile of the loan. So in regards to the cost of funds, the main banks' the cost of funds is derived in part by the official cash rate, and that's 1.5% at the moment. And that is the wholesale rate that the banks borrow money in New Zealand, and then they lend onward on top of that with a margin. And because they have those protections in place in regards to the way that they assess their loans and their restriction and their criteria, they can lend it out at a lower amount because the perceived risk is lower, that the loan's going to go into default. Whereas in the non-bank market, we have to obtain our funds from alternative sources. And that could be wholesale, it could be through private institutions like large corporates, it could be through investors. And the cost of those funds is going to be more. And that could be 5% or more. And that's the first difference that you come across with the cost of funds.
If you think about that logically,
Exactly.
if you had effectively higher the risk, higher the premium attached to that,
That's
hence
right.
a larger interest rate for the end user, right?
Yes. And in regards to the risk of the loan, but I like to, say, well, what's the cost of opportunity?
Exactly. Totally, yeah.
And, if you have this idea or this situation that you may or may not have selected to be put into, is the cost of opportunity for paying a bit more for a short period of time better or worse for you than the outcome that's going to happen?
Excellent way to frame it. Because that's exactly what it is. It's opportunity cost equals the premium that you're paying on that rate. Because you're not going to get that money at 4%, so just forget it.
That's
it's not
right.
happening. I guess it links to this other thing, which is a tendency for people to focus on something that they can readily understand, something that's quite simple, which is a number, which is the interest rate. It's very easy to kind of get that. Lower, good. Higher, bad. That's kind of how most people are hardwired to think. But really, there's another calculation that you should do, especially if you're thinking with more of a business hat on.
Yes.
And that's the overall cost of financing.
Yes.
It's the finance cost as a dollar amount, right?
That's right.
And I guess that would be one of the ways that you could help resolve that issue. Is that what you kind of do? Is express
Absolutely.
it as, here's the opportunity, but here's your funding cost to achieve this opportunity.
I would totally agree with that. And sometimes it's about educating the customer about that, the cost of this funding may be an extra, let's say $5,000. But what can you achieve with that funding? Is it what you're going to achieve going to be more than the cost of $5,000 or less? And you can put it as simply as that. The other thing about interest rate, and I sort of use the analogy of an iceberg.
Yeah.
Interest rate is what you see above the water. And everyone knows it, everyone can see it. But sometimes it's not the interest rate that's going to sink the ship. It's everything below. So I talk about what we call IRR, or internal rate of return. Because in the non-bank industry, there's more costs than just the interest rate. There is establishment fees. There may be line fees, unutilized fees, the list goes on. So I say to my clients, don't focus too much on the interest rate. It's a very important part, but it doesn't make up the full picture. And you can use an example of, let's say you got offered an interest rate of 6.95 plus a 1% fee for 9 months. Or there was 7.25 plus 1% fee for 12 months. Now, if you just looked at it from an interest rate perspective, you'd go, oh, well, I'll take the 9 months. But perhaps you wanted a 12-month term.
Mm-hmm. That's right.
Now,
your interest cost is a function of time, not just the rate.
Correct. So you go, oh, look, I really wanted 12 because I think my business needs to perform for a 12-month term rather than 9, but I like that interest rate. It's perceived as cheaper.
Mm-hmm.
But what happens if you hit that 9-month term?
You can't roll it over.
well, you'd have to roll it over, and that's when another fee is charged, and all of a sudden that 12 months looked really attractive,
Got it.
and
Yeah.
that's when an IRR sort of becomes a good metric
Yeah.
of cost,
Right.
and that's essentially the cost of the interest rate plus the fees on an annualized basis.
Right.
Because it's like an apple and a pear,
Yeah.
a 9 and a 12 month.
Yeah.
But if you can annualize it, you're talking apples and
Gotcha.
apples.
I guess it also is it's consistent with how you would be making a decision based on that project that you're about to do anyway. Because
That's right.
You want to know what rate of return you would require to make doing this project worthwhile. And so it's kind of speaking the same language, isn't it?
It is.
Yeah.
It is.
Like any business, like any industry, there's a subset within that industry, and there are different types of solutions for different types of clients.
Yes.
And to a certain degree, some people kind of have to hunt around until they find the right fit.
Yes.
And New Zealand is a small market, but if you could just describe to me the landscape a little bit now around this non-bank community, for lack of a better term,
Sure.
what kind of solutions are there for what kind of people? Because you might have some risky, really high risk development funding. You might have credit impaired lending. You might have to have a solution for someone on the books for a long time or a short time. So do you want to just talk to that a little bit?
Yeah, absolutely. I tend to say that the non-bank sector is placed into two categories. One is long-term mortgages, and the second is short-term loans or asset loans. So talking of the long-term mortgages, these are by institutions that act very much like a bank.
Okay.
They have the same sort of credit criteria. They provide very similar products. When we're talking, loans of 20 years plus, that they have fixed or floating, and the interest rates are very much near a bank's.
That's right. Yeah.
And they sort of cater for those people that didn't quite meet the bank's criteria on one part, and that they are, in the broader sense, a great lend, a great customer, but they may have just not met one of those criteria. And that is a very large part of New Zealand's market.
So I guess for all intents and purposes, we could probably call that a near bank.
Correct.
Rather than a non-bank, right?
That's right. And
Yeah.
they do like that tagline,
Yeah.
near bank
Yeah.
lending. And it's actually quite correct.
Yeah. It's kind of like McDonald's versus Subway. One of it's almost food.
Yes.
The other one is, I don't know if that's appropriate, but no disrespect intended. But again, these near banks are picking up some of the crumbs that fall off the table, some of the stuff, pretty good morsels, pretty good fair
yes.
business. But typically, people that would fall into the near bank solution would be newly self-employed. Maybe they have some low level of credit impairment. They haven't behaved properly with another financial institution in the past.
Mm-hmm.
Or maybe they have slightly less deposit than what would be required, either it's security property or them as a person.
That's right.
Is that kind of where they would fit?
Typically, yes, it becomes a matter of a deposit. For investors, it may be the loan-to-value restrictions that the bank has on investment properties.
It's a classic example that a lot of people might understand if they're property investors, because I know a lot of people in the show. They are property investors, and they maybe have gone up to 80% on their owner-occupied home,
Yes.
but they can only borrow up to 70% on their investment property securities.
Yes.
However, and I'm not including the new builds, but if you have pre-existing investment properties, or you want to buy pre-existing investment properties and build a portfolio like that, a non-bank alternative, in some cases, could allow you to go to 80%.
That's correct.
Because they're not subject to the Reserve Bank rules around LVR limitations.
That's right.
Yeah.
That's right.
Okay. Sorry to interrupt, Simon. As you
No
were.
problem. The second sort of category is your short-term or asset lenders.
Yeah.
And they sort of provide a far more flexible credit criteria and cater to those that are sort of looking for a very specific financial goal or outcome.
Okay.
So this could include, property construction, subdivisions, release of equity for a purchase of a business or something like that, where the term of the loan is only going to be maybe 3 months up to 2 years.
Sure. Okay. So would you kind of call this short-term like project funding, or what would you kind of label that for the layman?
Yes, well, I call it, opportunity funding.
Yeah. Okay.
You might have put yourself into a bit of a pickle.
Yeah. It might be situations that you have controlled yourself, and you are kind of, sure, you made a mistake, maybe you didn't know, whatever. But there's other external things that may have happened to you, but you find yourself in a wee bit of a spot of bother.
Yes.
And
yes.
you want to be given an opportunity, and that might be 3, 6, maybe up to 12 months, where the interest rate obviously goes up because
That's right.
that lender who is going to be providing that opportunity needs to get something to justify taking the risk.
Correct.
And it's over a shorter period of time.
That's right, and the sort of the interest rates that you'd be typically looking at in the sort of short-term asset lender market is, probably 7 to 10,
Yeah.
and north of that.
Yeah. So, and I remember, going back 10 years ago, that would have been 14 to 19%, basically
Correct.
just put on your credit card.
Correct.
So, but that says something about where that OCR has gone over time and where the overall
Well, that's
funding
right.
costs have gone.
I mean, I remember in 2009 the floating rate was 10% for
It's crazy, isn't it?
for a loan at the bank.
Yeah.
So yes, and that sort of short-term asset lender has a very specific place in the market,
Okay.
and that's typically where I play
Yeah.
into sort of that sort of term rather than that longer-term investor
Yeah.
type market.
Yes.
It's,
Okay.
it's about providing solutions to people and to get them to their financial goal.
Good.
And that could be to, go back to the main bank and be on their merry way,
Yeah.
or to achieve something, or maybe sell asset, but on their terms, not on someone else's terms.
So Simon, and we are nearing the end of our time together, but I'm keen just to hear maybe a couple of case studies from you, maybe
Sure.
a couple of examples of how you have saved the day, given that opportunity for somebody, and it works out to be a good, rosy outcome in the end.
Oh, absolutely. And I could talk to you for hours on that.
Yeah,
But, some of the most rewarding situations I've been in is when people are put into a position where their house goes on mortgagee sale. And, these people have been in property for 17, 20 years. It's the family home. And for whatever reason, they have got themselves into a bit of trouble with the bank, and they've perhaps fallen behind in their payments, or something hasn't quite worked out, and the bank has decided to put that out to mortgagee sale. And it's a very stressful time for people, and quite often than not, they just don't know what to do. I'm proud to say that we've helped multiple families
Cool.
in that sort of
That's
situation.
a really tough time. Like, you imagine someone basically giving you a letter and saying you've got 3 months to get out, and the reason why you've got that letter is usually because of something else, whether it's
Yes.
health, relationship, lost a job, you name it, right?
That's right.
So they're going through hell on earth.
Absolutely.
And to be told that you now need to move as well has got to be one of the most horrific things to have to go through. But I guess there's a certain journey that people have to go through to get to a stage where they acknowledge that, right, we need to act here. We can't just keep on waiting
Yes.
and hope that the bank will sell our property and give us the leftovers, because they're not really interested in you getting your profit.
No, they're not.
They just need to get repaid, right?
Yes, that's correct. They are concerned, firstly, to get their debt repaid.
Yeah.
Anything on top is,
That's
back
right.
to the customer. But, to talk about, I've seen house problems, separations, divorce, loss of job, etc. And, that sort of compounds the situation to make it even worse for them.
Yes.
And, there are solutions out there that can get them through that, and they can keep their home, because what the worst case is that they walk away with nothing.
Correct. That's right.
They walk
And
away
they
with
have
nothing.
nothing to start with again.
That's right. And, yes, you might be paying a bit more of your interest rate for a short period of time,
Yeah.
but is it really worth losing your house over,
Exactly.
or all that capital gain that
Yeah.
you've earned over those years?
Yeah.
Another thing that we see quite a lot is people that are wanting to capitalise on their property that they want to do a subdivide and a build.
Okay. Yeah. Actually, this comes up quite a lot.
It does. It does
Yeah.
come up quite a lot
Yeah.
because the metrics of the bank say that you need to be able to service that loan during that period.
Yes.
But the cost of construction and subdivision can be, in the hundreds of thousands. But there's a clear exit there, is that, i.e., I'm going to sell that property, make a profit, or I'm going to move into it and sell our existing property, etc. It's about seeing that future potential income,
Yes.
or seeing that future potential profit from sale
Yes. Yeah.
that we look at compared to the as is now sort of
that's right.
situation.
Because the traditional lender will be looking at the as is, and under the worst case scenario, that it's going to cost you way more than you realize, take way longer than you realize, and something else is going to go wrong. They don't want to take that risk.
That's right.
But again, big picture thinking, applying discretion, actually thinking about this, a non-bank alternative could actually be fine, because it's going to be a short-term lend until you have two titles. You go back to the bank, either one's rented out, you've lived in the other, you've sold the other. Exit strategy.
Correct.
So you see that quite a bit?
I see it a lot.
That's cool.
Yeah.
So to finish up on another example, something completely different. If I was an importer and I was importing goods from overseas, you guys have something pretty cool in terms of a product. Do you want to just tell us about that as well?
Sure. So we have some interesting funding opportunities with China.
Cool.
And ironically, it's come about thanks to our friend Trump.
So we'll call it China then. Not China, but China.
Yeah, that's right. So China is looking to bolster their exporting through other countries. Now, New Zealand is a dot at the bottom of the map and a very small player, but they are very keen to build relationships with other countries. And what we've seen is that there is opportunities whereby importers of goods in New Zealand and Australia from China can actually have this partially funded over in China. So instead of paying 100% of the procurement cost of your goods, we call this an unsecured trade credit facility, where you actually only have to pay up 30% initially,
Yeah.
and that 70% is funded by the Chinese funding line for 180 days from the date of lading, which is when it gets on the ship.
Yeah.
And if you think of that from a business perspective, you could essentially triple your purchasing power
Yeah.
using the same amount of capital, or you could use
Reserve
that
capital, right?
exactly. You
Reserve
could use
working
that capital that you've saved for that period for cash flow, for growth.
Correct.
And on the premise that you've got a product that has got a sales cycle that would benefit from sort of a 180-day term,
Correct.
you can get that stock from China to New Zealand, off the boat and
Sold.
sold.
So I'm thinking heat pumps, outdoor furniture,
Yeah,
barbecue, you name it, right? All the stuff because everything now, it all comes from China now.
it all comes from China now.
But
Yeah.
now you have the funding to actually buy it from China as well. It comes built in with funding line.
Yes.
And I get it. Like strategically, it makes a lot of sense as well.
It does, because essentially they are bolstering their exports by helping fund that through. There is some criteria around that. There's minimum order amounts, etc., where it would really sort of benefit people that are doing high ticket value goods.
Correct.
Yeah,
That's right. And I'm sure that this would work well for probably pre-existing businesses also that are already
That's
doing
right.
business in that market.
That's right. It's really for businesses that are further in their cycle than, say, a startup.
Yeah. But that's cool, because I think at a certain stage in the growth of that business, you're going to hit a barrier, going to hit that ceiling. But that sounds like a really cool opportunity for some firms to maybe move forward with that and grow wealth in their business that way.
Yeah, it is a niche product, but for the right person, it is a game changer.
Yeah, interesting. Cool. Hey, Simon, I want to thank you very much for coming on the show.
I appreciate
That's
your
really
time.
cool. If people want to reach out to you and maybe something that they've heard about kind of triggers something and they think, I know somebody, or maybe that's me, what's the best way for someone to get a hold of you?
Get in touch with me via LinkedIn.
Yeah.
I've got some content on there, sort of talking about what we talked about today, demystifying the non-bank.
Yeah, cool.
You know, that's what I'm passionate about,
Yeah.
and they can connect and follow me. And if they've got any queries, just drop me a line.
Or just swallow your questions and get over it. No, it's good.
But
Thank you.
I do appreciate your time,
Yeah,
and
no
I've
worries.
really enjoyed it.
Fantastic, Simon. Same here. Well done. Thank you.
Thanks.
Cheers.